Palantir stock is once again at the center of market debate after a senior analyst at RBC Capital issued a starkly bearish assessment that has investors questioning whether holding shares still makes sense. The warning arrives at a sensitive moment for Palantir, as the stock has already experienced notable weakness and sentiment has become increasingly divided across Wall Street. According to a research note released today, RBC analyst Rishi Jaluria reiterated his underperform rating on Palantir and assigned a price target of $50. This target implies a potential decline of roughly 70% from current trading levels. This cautious stance is even more striking given that Palantir shares have already dropped by more than 20% over the past 2 months, suggesting that the stock has been under sustained pressure even before this latest downgrade reinforced bearish expectations. RBC's rationale for recommending reduced exposure to Palantir stock is primarily rooted in concerns surrounding contract momentum. The firm's internal government data tracking indicates that Palantir is experiencing declines in both qualified contract value and net annual contract value. These metrics are particularly important because government contracts have historically been a cornerstone of Palantir's revenue base, providing stability and long-term visibility. Any signs of weakening in this area naturally raise red flags about future growth and revenue durability. Looking beyond government business, the commercial outlook does not appear significantly more encouraging, at least according to Jaluria. In conversations with clients on Tuesday, he explained that recent checks suggest certain commercial customers are reassessing their long-term commitment to the Palantir ecosystem. This type of reevaluation can be especially concerning for a company whose strategy relies heavily on deep integration with customer data systems and multi-year relationships. If customers begin questioning the long-term value proposition, it could slow expansion opportunities and dampen future contract wins. From a technical analysis standpoint, the stock's recent behavior adds another layer of caution. Palantir's relative strength index over the 14-day period currently sits near 39, a level that often indicates continued downward momentum rather than a clear oversold bounce. This suggests that selling pressure may not have fully played out yet. Jaluria emphasized that heading into the upcoming earnings report on February 2nd, the overall risk-reward setup for Palantir shares appears skewed toward the downside. Valuation remains one of the most frequently cited concerns among skeptics, positioning it among the most expensive established artificial intelligence-related companies expected to carry into 2026. Such a premium valuation leaves very little margin for error. Even modest disappointments in growth, margins, or guidance could result in outsized stock reactions as investors reassess how much they are willing to pay for future earnings. Another factor weighing on sentiment is insider activity. Over the past 6 months, Palantir insiders have predominantly sold shares rather than accumulated them. While insider selling does not always signal trouble, consistent selling can be interpreted by the market as a sign that those closest to the business believe the stock is fully valued or even overpriced at current levels. This perception can further undermine confidence, especially when combined with broader valuation concerns. Technical signals also point to continued caution. Palantir shares have recently fallen below their 100-day moving average, a level many traders view as an important trend indicator. Trading below this threshold often suggests that bearish momentum could persist in the near term, reinforcing the view that the stock may struggle to regain upward traction without a strong catalyst. Despite this bearish narrative, Wall Street is far from unified in its outlook. Other analysts remain far more optimistic about Palantir's long-term prospects. According to data from Barchart, the consensus rating on Palantir shares currently stands at hold. The average price target of approximately $201 implies potential upside of more than 20% from current levels. This wide divergence in price targets highlights just how polarized opinions have become around the stock. As investors look ahead to the earnings report scheduled for February 2nd, much of the focus will be on what has fueled Palantir's dramatic rise in the first place. Palantir has emerged as one of the most recognizable names in the artificial intelligence space, not because it builds consumer-facing products, but because it embeds artificial intelligence into existing enterprise data environments. Its software helps large organizations organize, integrate, and analyze massive volumes of complex data, enabling more informed decision-making. This approach has allowed Palantir to secure long-term agreements with major institutions across a wide range of industries, including government, defense, and large commercial enterprises. leases. These contracts often span multiple years, creating recurring revenue streams that can provide stability and predictability over time. This business model has been a major contributor to investor enthusiasm and has played a central role in the stock's strong performance during its rally. Since becoming a publicly traded company in 2020, Palantir has recently reached a scale that is contributing to accelerating revenue growth. At the same time, the company has been making progress on profitability, an important milestone for a business that spent years prioritizing expansion over earnings. This combination of growth and improving margins has helped justify an extremely elevated valuation. Currently, Palantir trades at roughly 416 times trailing 12-month earnings, a figure that underscores just how much future success is already priced into the stock. Whether the shares continue to climb or face further pressure may largely depend on the trajectory of revenue growth from here. If growth continues to accelerate, investors may remain willing to tolerate the premium valuation. However, if the company has reached a point where scaling naturally leads to slower expansion, the market could quickly reassess how much it is willing to pay. For that reason, the single most important element to watch in the upcoming earnings report will be the pace and direction of revenue growth. Investors will be closely analyzing whether Palantir can continue delivering accelerating top-line performance or whether signs of deceleration begin to emerge. The answer to that question may ultimately determine whether the bearish warnings prove prescient or overly pessimistic. For more stock news updates, remember to press the like button and subscribe. With that being said, I will see you in the next video.